Welcome to Daily Market Reflection for the June 24th, 2026 close. The central tension is that the growth and AI tape feels heavy, while the wider risk dashboard has not confirmed a systemic break. QQQ is down over 5 sessions and several semiconductor-linked names are pausing, but VIX is near 20 rather than panic. Put-call data does not show a hedge stampede, and IWM is holding up better. That keeps the base case in digestion and rotation, not crash. The important point is process, not prediction. A market can look uncomfortable and still be doing normal repair. Today the evidence says to respect the pullback, but also to avoid turning one-week tape into a complete macro story without confirmation. Before any ticker discussion, the market regime comes first. Today, the better label is choppy upward trend with short-term digestion. Momentum has cooled and leadership needs repair, but the evidence is not broad enough to call a crash risk regime. The practical response is not all in or all out. It is to separate core exposure from swing risk and wait for confirmation before adding aggressively. A digestion regime usually produces frustrating two-way action. Strong opens can fade, weak opens can reverse, and sector leadership can change quickly. That is why the plan should define both the upside and downside response before the next session begins. The macro backdrop has one obvious pressure point: the dollar. The dashboard flags a sharp dollar rise, while the 10-year yield is not the main source of pressure today. Retail sentiment is slightly cautious based on the AAII bull-bear spread, and the next listed macro checkpoint is the July CPI release. In this setup, macro is a headwind to monitor, not yet a complete thesis break. If the dollar keeps rising, it can pressure global liquidity and valuation multiples, especially in longer duration growth. If it stalls, part of today's stress can fade quickly. That makes the dollar a confirmation variable rather than a headline to trade mechanically. Index structure is mixed. SPY and QQQ are negative over 5 days, while IWM is positive. That means the headline index pressure is real, but it is not synchronized selling across every equity pocket. QQQ is the key repair test. Reclaiming short-term averages would support stabilization, while failing around the 50-day area would raise the risk of a deeper retest. For index work, the most useful question is not whether the market is red today. The useful question is whether support breaks and then fails to reclaim. A fast reclaim would say buyers still defend the trend. A failed reclaim would say the market needs more time. The rotation snapshot is why crash language remains premature. Money does not simply disappear. It often changes location. The tape shows pressure in high-duration growth and technology, but small caps and some defensive or cyclical areas are not breaking in the same way. That is healthier than a synchronized liquidation, although it still argues for patience in crowded AI leadership. Rotation is the market's pressure valve. When leadership rests but other groups absorb capital, the bull trend can digest without collapsing. When every group falls together, the message changes. Today, the data still looks closer to rotation than synchronized liquidation. The dashboard says mild stress and monitor confirmation. VIX is near the 20 threshold, total put call is not panic, and the credit proxy is softer but not broken. The dollar is the clearest stress flag. A crash risk call would require several of these indicators to deteriorate together, especially credit, volatility, breadth, and support structure. The dashboard also helps control emotion. VIX near 20 deserves attention, but panic usually needs a cluster. Volatility, credit, dollar, breadth, and price structure all breaking together. We do not have that full cluster in the available same-day data. AI and semiconductor leadership is where the short-term pressure is concentrated. Trend pauses in MRVL, MU, SOXX, and the leverage-sensitive SOXL show that the group needs repair. This does not automatically end the AI theme, but it does change execution. For swing timing, the market needs stabilization, support reclaim, and ideally better volume before treating weakness as a clean add window. For AI hardware, The next few sessions matter because high beta groups often overshoot in both directions. A lower volume pullback into support can be constructive. A high volume support loss with failed rebound would be a different message. Time horizon matters. Long-term investors can focus on whether the thesis and weekly structure remain intact. Swing traders should demand a better support reclaim or momentum repair. Intraday traders should be careful with reflex bounces and leveraged ETFs. The same candle can be a long-term opportunity and an intraday trap. This horizon split prevents common mistakes. A long-term holder should not use an intraday panic rule, and a day trader should not justify a losing scalp with a 10-year thesis. Each layer needs its own invalidation point. A balanced plan keeps both shares and cash. Shares allow participation if stabilization comes quickly. Cash gives flexibility if the pullback deepens. Ads should come near support or after stabilization, not from emotional chasing. The bearish red strengthens only if support failures, broader selling, credit deterioration, and volatility acceleration confirm together. A practical plan might keep a core, reserve cash, and use smaller swing ads only when the tape stabilizes. That structure leaves room to participate if the market turns, but avoids being forced to sell if the digestion extends. The base case is choppy digestion with rotation under the surface. The bull case needs QQQ to reclaim key averages, VIX to cool, the dollar to stop accelerating, and semiconductors to stabilize. The bear case needs broad support breaks, expanding down volume and deterioration in credit and volatility. This is market commentary and educational content only, not financial advice. Going into the next session, watch whether bad news creates new lows, whether QQQ can reclaim short-term structure, whether small caps keep their relative resilience, and whether the dollar cools. Those confirmations matter more than any single candle.